Welcome to Eternal Elements Learning Podcast, brought to you by Atyasa Online. These podcasts are a part of the audio certificate programs on Atyasa Online. You're free to take these podcasts on your desired portal also, should you only wish to learn on the go. Thank you so much for engaging on these podcasts, and you can connect with the author on LinkedIn, Twitter, and Facebook. Hi, this is Niket Karajagi. Welcome back to Eternal Elements, brought to you by Atyasa Online. Now, we are talking about controlling the operations of the organization. We spoke about the responsibility centers. In the responsibility center, we talked about the revenue centers, we talked about the expense centers, we talked about profit centers, and we talked about investment centers. Obviously, these are operations which are transforming a management process, and therefore it's important to control the process. How do you control the process? The best way to control the process is through a general control characteristic process, which is a budget. What is a budget? It is a numerical representation of the plan. That means you formulate a strategy, you build a plan, and once you build a plan, then you have to put those plans into numbers, and those numbers reflect the budgets. The budget document typically is like a profit and loss account or a balance sheet or a fund flow statement or a cash flow statement. It is a statement which is a master budget which is being put in front of the management before the activity actually commences. Therefore, it's preemptive in nature. It's aligned to the plan. Now, how does this work? The market research or the market intelligence or the marketing department, whatever you may choose to call, in the 21st century, we use a lot of analytics. You determine what the market size looks to be. You take that data and bring it into your production plan, which is based on the actual capacity that you carry. If it's a service organization, you're looking at the unit of number of days or number of hours that you can service a customer with. If you're looking at a typical production house, then you're looking at a setup like a shop floor where you decide on the number of units that you can manufacture, which is based on the capacity of the plant. Once you determine how much of the capacity that you're going to use, then you get into your material plan, then you start moving into your production plan, you start moving into your HR planning process, you start moving into a whole lot of other things, and ultimately it culminates into a profit and loss account and a balance sheet, a cash flow statement, and the fund flow statement, and together they create a master budget for you. How is a budget prepared? Well, when you're preparing a budget, you can look at the engineered expense centers. The engineered expense centers are typically where the cost of performing a task is actually predetermined. Because it is engineered, it's based on standards. If it's a discretionary cost center, then the management formulates the budget by determining the magnitude of the job that needs to be done. Standards can be set for inputs which are tangible, but service is not tangible, and therefore it is based on the magnitude of the job that needs to be done. And once that is done, then obviously the budget has to be set into place. The technique often used in preparing a discretionary expense center budget is management by objectives, because it's discretionary, right? You are not having a tangible unit in, and therefore you can't determine how much is the cost of the input. However, you can determine what is it that's going to take to create that output that you're dealing with. And therefore, management by objectives is typically dealt with discretionary expense centers. A formal process in which the budgetee proposes to accomplish a specific job and suggests the measurements to be used in performance evaluation is a part of management by objectives. That means the person who's going to do the job is the budgetee, and he talks about or she talks about how the performance is going to be evaluated, and that becomes the part of the budget. Now, there are two ways in which budgets can be done. You have the incremental budgeting and you have the zero-based budgeting. This is obviously done at the planning stage because budgets always happen at the planning stage. And like I said, budget is a numerical representation of the plan. Now, what is incremental budgeting? Incremental budgeting is a model in which the current level of expense is taken to be the starting point, and then the amount is adjusted for inflation, anticipating changes in the workload of the job, special jobs if at all we're going to take, and then we actually build up a budget which is incremental in nature. Now, a budget could be a fixed budget or a flexible budget. In a fixed budget, the capacity is determined and there is no deviation permitted. However, a flexible budget allows you to build up different models in the budget, so those models actually operate based on the capacity at which the plant is operating. Incremental budget, the problem typically is that the current level expenditures are accepted and not reviewed at all. And the managers typically want to increase the level of expenses, and they do that because they want to play safe. And this is called the upward creep. The upward creep is a normal thing when it comes to budgeting, because what employees tend to do when they're budgeting is they always take an incremental shift and they tend to overstate it. Zero-based budgeting is another option, but it's like working right from scratch, and it's though the analysis of each center is done in a rolling schedule of 5 years. There's an intensive review that is done, and from the scratch everything is built up in form of a budget. It is expected that the expenses will creep up in this also, but it's controlled to a large extent. Zero-based budgets are time-consuming, and managers do their best to justify their current level of spending because they want to hold on to their fort. Therefore, in a zero-based budgeting, you really have to push it hard. You really have to question the managers hard. This is the way budgeting tends to happen. A budget typically becomes a master document which comprises financial control, where you have financial statements that are worked out. And like I said, it's primarily your balance sheet, your profit and loss account, it's your cash flow plan, it's your fund flow plan. Apart from that, ratios are also taken in to look at the performance of the responsibility centers. These are financial ratios that are used. Financial ratios typically tell us what is it that the company looks like when it comes into operative analysis. You have different ratios. You have the liquidity ratio, you have the asset management ratios, you have the debt management ratios, and you have the profitability ratios. When you are looking at these ratios, you can actually map a trend, and when you map a trend, you know how the performance is actually happening. And that's the way you tend to control through budgets and through the financial ratios. So the financial statements, the financial ratio analysis allows you to do budgetary control. Now, what is budgetary control all about? The moment you see a variance happening from what you budgeted and what the actual numbers look like, you immediately put the control process into play. And that's the budgetary control. That means every month, every quarter, you're doing a review, or maybe twice a year, you're doing a review where you sit down and you say, hey, look, are we going in line with our budget, or do we need to relook at our operations and we need to look at where we are actually losing out on our standards? So budgetary control is an aspect of the control system. We also have quality control. I talked about quality in the earlier podcast. We also do a lot of inventory control, because ultimately when you stock too much of inventory, or when the inventory gets stocked out, you lose money. And therefore inventory control also happens to be one of the control mechanisms. And then you have the operations management, where the way you run your production unit is all about operations management, where every aspect of KPI is monitored, something that we covered in the balance scorecard. Every aspect of the KPI is monitored and it is controlled for any deviation that sets in. This is how management control operates. You have financial control, which comprises financial statements and ratio analysis, where you do the trend mapping. You have the budgetary control, where you check for variances on actual figures that are happening in the organization to the planned figures, and then you take corrective action. You look at quality control, and you can look at various procedures to do the quality control. Any deviations in the quality are checked there. You look at the inventory control, and finally, you look at the operations control based on the KPIs that have been set. Thank you very much. This is Niket Karajagi signing off from Eternal Elements. I was talking to you about budget and various control techniques. In the next podcast, which is going to be our last podcast, I'm going to talk about management information system, because in the 21st century, we're working towards strong analytics, and therefore it's very, very important to dig into the aspect of management information systems, and that's what we shall do in the next podcast. Thank you very much. I'll see you in the next podcast again.